Welcome to another Market Radar podcast. Hope you've been having a great weekend. Here on the screen is the year-to-date performances. So far, we're seeing IWM leading, followed by the NASDAQ. So fairly proper order so far. Nothing strange going on here. Obviously, you're going to have small caps rallying more than everything else. Let's take a look at the calendar for next week. We've got a pretty busy week in terms of speakers. There's going to be a lot of Fed speakers on Tuesday, Wednesday, and Thursday. And then Monday is a holiday. Market is closed. Don't forget about that. We also have jobless claims on Thursday. That's going to be important to look out for. Other than that, nothing too crazy going on, but we will be listening closely to the Fed speakers and their outlook on the market.
Okay, and let's go over what we saw happen this week with inflation. This was the big release this week. Everyone had their eyes on it. And more importantly, the way it came in obviously influenced markets into the end of the week. So we saw inflation come in at consensus at 6.5% on the headline numbers, year over year change. Now, this is lower than the prior print and the print before that. Obviously, we have a peak above 9%. So we're decently off the peak now. And the question that's starting to form is, has inflation truly peaked? We're going to go over this in the podcast. We're going to talk a little bit about the Fed, but more importantly, let's get into what the markets did with this inline print this week. So we had ES come up off of mid-vamp earlier this week, and then into the inflation print, we saw it chop around and then rally higher into the end of the week. Now, ES is obviously off of its range, this choppy consolidation range where we've broken out of it. It seems we want Momo here, but we're going to see. The key to this is that it's bearish trend, right? So as ES remains bearish trend, you're going to need to have one of two things happen here. The trend's either going to break to the upside, or you're going to get a rejection and you're going to lose mid vamp. Now that's a key pivotal moment in the trend for you to get that reversal. If you look back in time, right, whenever you got the Momo touches, you needed to lose mid-vamp to get the price momentum to continue lower. So if you're short this, or you're trying to short this at Momo, be very keen on what needs to happen here, especially with taking out mid-vamp. Like if you're getting short and you can't take out mid-vamp, you may have some upside risks to worry about. Vice versa, if you're trying to get long and it's not bullish trend, well, then the trend is not your friend. So just keep that in mind, what you're trying to do here. A lot of people are trying to gear themselves up for a squeeze. We don't see that happening. But if it does go bullish trend, we have to take it as it is. And obviously, we'll see how the system moves at that point. Right now, we are risk off still, and we will see how the system updates in the coming weeks.
But something I want to add to that, keep in mind, we're still in a non-directional regime. So cash is king still. It really depends on your trading style. If you like short-term trading, there is potential for a short at Momo using a bullish trend as the stop loss. But at the end of the day, it's a non-directional regime. This is notorious for screwing over both longs and shorts. So it's very unwise to use size in trading right now.
Yeah, that's a good point. And let's go over liquidity. So this is something, the liquidity risk index, the LRI, it's our proprietary index, that we track through TradingView. And this compares the liquidity conditions to the VIX. Historically, they are well correlated, and as of late, they've been disconnected. Now, obviously, at some point, they're going to meet up again, but the question really is when. And historically, when the LRI is under 70, the market does rather well. Now, we had this flash crash blip here, but this was maybe one day, and we reverted, and we're back in the 90s, the high 90s. And this is, again, going to be something that's on our radar because VIX is slowly breaking down, yet illiquidity can't really get under this 100 area, or at least break free of it completely. So this is telling us that liquidity conditions remain poor while VIX is slowly improving and the market's rallying, also telling us simply the market's rallying on illiquidity.
Right. Could you touch more on what that flash crash is? What caused that, and does that have any significance?
Yeah, it has to do with the surge in that 1 day surge with the overnight repos, and it has to do with the way the balance sheet has been trending and the way the dollar has been moving. And it's not as it would be more significant if it lasted more than a day. But I think the way it happened was the data got reported and the day got closed out, and then we moved to the next day, and we literally, I mean, we're talking 1 day here.
Right.
So
Okay.
I wouldn't hold much weight to it. I mean, if we did see this hold, though, that would be a huge signal. But there would likely have to be a bit more surrounding the context than just this indicator. A move like this on the LRI would likely be followed by some type of action. Like, for example, when the LRI shot up here, this was because the market was basically shut down, and when
Hmm.
it snapped back, this was the Fed basically pumping liquidity into the illiquid market, right? That's what this was. The emergency rate cuts, the QE, all that nonsense that was pretty much thrown at the wall here was able. That's what was needed to bring this whole the whole LRI and VIX back down.
Hmm.
Now,
Okay, so this one completely can be completely disregarded.
right, yeah, don't worry about this thing here. And obviously with VIX, we're down, but I wouldn't put VIX out of the equation just yet. It's good to see sub 20 VIX. I'd have to say that, but you also have to realize that markets are off their lows, and move to their lows would obviously get VIX moving again. Now, is VIX going to go 34 plus? No, but just remember, even 18 VIX is historically high. So pre-COVID, we were at like 13 VIX. So
Right.
18 VIX
We
is
actually
already up
never
there.
really went back to the VIX levels pre-COVID yet.
No, we haven't. And I mean, a move from here down to there would be down to the 11s and 12s. Like you're talking, I mean, you're talking an epic rally, which I don't. Obviously, the system doesn't see happening right now. At least not yet. But we'll see how the system progresses. Let's move on to bonds. So something interesting happened here. Obviously, CPI bonds chopped around, bonds went up, but we went over this in pre the video release the night before the CPI release, and we illustrated that the bonds were telling us something's off, right? The market pretty much didn't. The market didn't move too much after CPI. It went up a bit, but it wasn't that drastic as we've seen in prior reports because it was in line. The market kind of knew what it was going to be, and we played it out kind of perfectly, right? Now, bonds, on the other hand, they knew as well, except they are under their prior lows, so prior highs, excuse me. So if we just draw a line here, this is their prior peak into the last. This white line here is the inflation, the CPI report in December. Now we had the CPI report in January, so we've gone through two reports. Yet bonds are not as high as they were in the prior report, or in the prior report, right? Because the one just came out. But bonds are below that December high. Now, why would bonds or rates be higher than where they were in December, especially long bonds, if inflation was truly getting better? We should be above this level. Now, maybe we get above this level next week, and we can start squeezing because bonds still have almost a 7% move to Momo, and that could all be counter trend. But the fact that we went into the CPI report not even at these highs was a little concerning to me, because again, why if even if inflation came in line, bonds should still be above. Bonds should be progressing a lot better than they are, and that leads me to believe that maybe the inflation situation isn't going to be fixed as easily as the Fed is, or at least the the forward curve market is predicting.
Well, so what could be the issue here? Like
So,
would inflation rebound? So it didn't actually peak and we would get a reversal? Is that kind of what it's pricing in or what?
well, there's two things, right? So inflation coming down, right? It's a good thing, right? So coming in, even coming in at even excuse me, coming in at consensus, for equity markets, but more specifically bond markets, is a good thing as bonds and equities are off their lows. But we have to clarify. I have to clarify this, and many people are cheering for their stocks as they see lower inflation prints, and that's really all nonsense. Because what's going to happen at some point is that slower or lower inflation is going to turn into deflation, and stocks will at least the indexes like Nasdaq and SPX, um, they're going to do they can or not they're gonna they can do worse than they have performed uh, like up to this point. So as they performed up to this point, they could do worse than
Right.
what
Well,
they've done.
deflation usually that's when you get the real sell off.
Right. And right now, like the idea of or what it seems like what's bolstering stocks is the idea of a soft landing. That's what's really bolstering the equities. The idea that growth can come back and we can have a booming economy, right? Because if you really think about it, if inflation was really seen as peaking and coming down quickly, well, then why would that would be deflationary? Why would the stock market rise on that, right?
Right. Well, so we're still kind of in a situation where all we need is rising growth. So we have the inflation component.
Yes.
If we get
Yes, that's
rising
true.
growth, we get into the expansion regime. Or sorry, the inflation regime. So positive inflation, positive growth.
Right. Yeah. Well, no. It would most likely be inflation for a little bit, but eventually we're going to get into that expansion phase, which you first mentioned. Yes, we're going to go up to inflation, then over to expansion, where inflation is decelerating
Hmm.
and growth is accelerating. But so there's some things about this growth thing that this whole growth trade. We're going to talk about it in a few minutes. That is very interesting because it's quite apparent there is no recession just yet, right? The market, if we look at incomes and all these other components I posted this week on Twitter, they are all signaling that the recession just isn't here yet. Unemployment, right? It's not, there's no recession just yet. Now, this is being relayed into the Fed funds rate too, right? We're seeing the Fed expecting to cut at least one and maybe two, cut by one or maybe two rate cuts by the end of the year, which is going to be either 25 or 50 basis points by the end of 2023. That's what we're seeing. Now, I personally don't expect that back end of the Fed forwards curve to fall, rather remain sticky because I expect the Fed to hold a bit longer than what the bond market or even the equity market is thinking. And there's two aspects to that issue. One being the Fed has been made the joke in the room, right? Like everyone has looked at the Fed and said, "You're no longer credible. You're no longer reliable." And the Fed has literally just come out this week multiple times saying they want to not they don't look to cut rates by at least the end of 2023, meaning like they have no intentions of cutting rates until 2024.
Right. And
So
so does the bond market believe that?
obviously not. The bond market doesn't believe the Fed in that instance, and I think that it would be a real let's just put it this way, it'd be a really unique situation for them to hold a terminal rate for only 2 months and then have to cut and add more water to the cup of no confidence, right? The Fed has this issue of not of having no confidence anymore from the public, right? No one believes what they say.
Yeah. Yeah.
So, like, why are you coming out and putting yourself in a position now basically bantering about how you're not going to cut rates in 2023, and then by halfway through the year you're going to start cutting rates,
Hmm. So what do
right?
you expect the EFFR to do?
I expect so the long end of the curve, I think the Fed's going to stay there for at least I mean right now we're looking the Fed holding for like 3 meetings, but I think it's going to be longer than that. And primarily this comes back to the issue, right? The whole point of cutting rates is to stimulate the economy. Why is the Fed going to blow its powder on cutting rates unless there's an actual recession that emerges? Now,
Right.
the recession would have to emerge within 6 months. What the bond markets, I should say, the forward curves are telling you is that there's going to be a reason for the Fed to start cutting in at least 6 months, right?
Hmm.
But given where rates have risen from, right, we're at 400 or over 400 basis points on the Fed funds rate. We've come up from zero to 400 within a year. So it's not like this 400 has been sitting here for very long.
Right. So it's going to take some time for the effects of that 400 basis point hike to really take effect, and it'll be
Yeah,
longer than 6 months.
I think it's going to be longer than 6 months, but
Yeah.
again, we'll see. This is something that we can progress with and see. Like, you the first thing I would take a look at is like where we see inflation coming in by the end of the year. Obviously, we can't tell you that because that's a gamble, right? To the exact point, the idea is
Hmm.
inflation going to be substantially lower or not? It's
Yeah.
not, oh, is it going to be 3.5, 4.5, 5.5? No, it's going to be in the fives. It's going to be in the four. Like, that's how you only have to know that much. It's not rocket science, right? So I think that the 400 to 480 to 500 basis point terminal is going to have to stay sticky for a while, because what the Fed's going to want to see is they're going to want to see an actual recession emerge before they really start cutting rates, because they want to make sure that inflation is truly under control. Now, if we look at how the traders are positioning themselves, we have to take into account what they're thinking. They're thinking a recession is going to emerge, but we all know that the only time the Fed will pivot is if an actual recession emerges. And I put this chart up on Twitter on Friday morning, and this is just a quick overview of the yield curve, right? The 10s and 20s. This is the most popular yield spread, right? It's part of the curve. It's a component of the yield curve. It's a piece of it, sliver, right? It's the 2s and the 10s, the differential. What you can see here is we're at negative 60, or as of this post, it was negative almost 70 basis points on the 2s and 10s. Now, if you notice something, I overlaid the NB the Fred, basically the Fred recession index. Okay, this gives you a positive value of 1 when there's a recession and 0 when there's no recession. So it only triggers when there's a recession.
Right. So it looks like it triggers after the Fed hikes every single time. So after the spread goes from negative to positive.
Right, exactly, and that's what I was making note in the chart. For you to get that recession that we all know that isn't here yet, right? You have to always make a plan and layer it out. So like, we always, the end
Wait,
goal
so are
here
you
is the.
saying the White House was right when they said that we're not in a recession after two negative GDP prints in a
Oh,
row?
listen, listen,
Are
listen. We
you
can
saying
talk
they're right?
semantics. We can talk semantics all we want at the time. At the time, listen, two negative GDP prints is a technical recession. I think that what they did, I think the way they got out of this was GDP was able to rebound, and we didn't get this whole scenario of the economy falling apart, primarily due to the fact of the lag. Remember what I said earlier? We went from 0 to 433 basis points in under a year. Typically, if you look at this chart, it's a slow rate. Like, look how long these rate hiking processes have, and like, sometimes you're not even at 0. Like, going into this 2020 reversion, call it COVID, right? Whatever. But the yield curve inverted prior, like, we were slowly climbing for like 4 5 years, 4 years.
Yeah. Yeah,
So
this
there's a
is
lot of time for things to get pushed around in markets and absorbed, a lot of debt to be refinanced higher.
yeah, now we're going to
Uh,
have just a massive lag and it's all just going to hit at once.
yes, I know, and that's the key here. So our end goal, the way we see this playing out is as follows. There is a possibility, because when you're talking about probabilities, there's always a possibility, right? There is a possibility of a short risk on regime. Material, I don't know. Do I think it's highly likely? Not at the moment. No. Do I think it's something we should worry about? No. But if it does happen, we just have to accept it and understand what's going on. I think what would happen at that point is, because in reality, the reason you're going to get that risk on regime is the recession isn't going to come fast enough. And the way the markets work is, if there's no recession, then it's a bull market, right?
Then it's game on. Growth.
Then it's
If
game
growth
on.
rebounds, it doesn't
Right.
matter if we still have inflation. It's game on.
Right. Now the question is, you now have a component in this scenario, in this risk on regime, that's very unique. You have the Fed against the growth regime. Unlike any other regime where growth is accelerating, the Fed is against this one. They will the terminals will go higher if inflation doesn't come. Because remember, if growth's really accelerating, well, that means the economy is still strong, right? So if the economy is still strong, there's really no reason for inflation to be controlled, right? So, because the idea of a soft landing is just an idea. Like, To get an actual soft landing, you need inflation to drop substantially, and that only happens in a recession.
So essentially, a
Right?
soft landing is impossible.
Essentially, but we'll let them talk it out and see. You can talk about specific time points in history, but if you really understand what inflation is and you understand why prices of goods would drop dramatically, and like think about it, prices of goods are not going to drop dramatically, and you have a booming economy,
Mm-hmm. Right.
right? Like why
Yeah,
would
it just
that
doesn't. It just doesn't work that way.
it
if
just
if
doesn't work
there's a
that way,
booming
right?
economy, like why would prices go down if people can afford them?
That's my point, right? So if we make an outline of where the Fed is going to go, the main objective, right, is going to be a Fed rate cut, right? A rate cut from the Fed. That's what we would need to spark the deflationary trade. Like I just said, there's some risk here that there's a risk on regime, but it's not very high at the moment. I think the ultimate play will then be that risk off regime, that deflationary regime, where at that point, what you're going to get is you're going to have the Fed backing the wind in your sail, basically putting the wind in your sails in the bond trade, pushing bond prices up as they cut the Fed funds rate, and you're going to have a recession, and it's going to be a typical situation where bonds do well. But if we understand the end point where the Fed has to cut, we have to map it out, and that's what I'm saying right here. So for us to get a recession, historically, every single time we needed a yield curve reversion, right?
Right. Well, so I just want to ask one last question. Keep this short, but you mentioned how you're expecting the Fed to hold rates at the terminal rate for longer than what the EFFR is currently showing, at least till the end of the year. So does that mean we're going to be staying in stagflation for the rest of this year? Is that what you're thinking?
No, there's a component to this that I know what you're asking and that I should explain. So even if we have inflation falling and we have technical deflation, the bond market will start front running the Fed if the Fed doesn't act quick enough. The bond market theoretically, the bond market always does front run the Fed to a degree, right?
Right. Okay. So there could be a deflation trade well before the
The
Fed
Fed
even
actually starts
starts
cutting,
cutting. Right.
right? And we'll finish it up on this idea where the Fed follows the bond. Or people will say the Fed follows the bond market, or people will say the bond market leads the Fed, right? But in reality, they work together. If the bond market doesn't think the Fed's going to cut rates, it's not going to move higher. Now, if the bond market only thinks the Fed's going to cut rates marginally, it's going to move up marginally. It's all percentages. This is all probabilities, right? If the bond market knows certain the Fed's going to cut rates because we have a recession and there has never really been a recession where the Fed hasn't cut rates, the bond market's going to skyrocket. But what's going to happen is the Fed's going to have to hold a little bit longer this time because we have the highest inflation we've seen in 40 something years or 40 years. The Fed's going to want to make sure that inflation is truly killed. Will it make a recession worse? Possibly. So what's going to happen is the bond market, I think, is going to be a bit earlier this time than it was in the prior cycles because the Fed's going to be a little, I'll call them stubborn. And I think the idea of them holding the terminal for 3 months, something tragic would have to happen for them to start. Like, okay, the Fed's not going to go to 500 basis points, in my opinion, and then reduce 25 basis points. Why would they do that?
Right. So
What's the point at that point?
it's gonna have to be a real cut for something. Like if something tragic is happening, it's not going to be a 25 basis point cut.
Well, what ends up happening is the Fed's put themselves in a position. They've hiked so rapidly and so aggressively. The first cut is their fold. Why cut rates by 25 basis points, right? If you look at the way the market's being everything's around rate hikes, rate hikes and rate cuts, excuse me. Rate cuts are off the table or have been for a while. Maybe they're starting to emerge at the back end of the curve. And the biggest bullish thing for a while was the idea that the Fed was just going to stop hiking rates. The idea the Fed would stop hiking rates was actually market bullish.
Right. Yeah.
Right. Bullshit, right? Nonsense. So think about one rate cut. Well, if you're cutting rates once, why are you cutting rates 20? What difference does 25 basis points on 500 basis points make? Unless you're actually pivoting. The only reason you would cut rates and put that out into the public's mind is if you're actually pivoting. So if you think rates are coming off their highs by mid 2023, you think the Fed's pivoted at that point. I don't see any other reason why the Fed would just reduce their rates 25 or 50 basis points for what? What problem are you solving with 25 basis points at 5%, right?
Mm-hmm.
It's not like you're at 3%. You do proportions, right? We do 25 divided by 500. That's 5%, right?
Right. So it's basically just negligible. So that's a good way that you put it, though. If the Fed cuts, regardless of how much, even if it's just 25 basis points, that's a fold. They're telling the market that it's time to pivot.
That's my point. Yeah. So like, I don't see why the Fed would do anything like that rapidly for no reason. Like you're doing some. It's okay. It's like playing a card game and starting to bluff, like with a shitty hand when you like it's everything. Like you could play that game, but the Fed's not in the gambling game here. You know what I mean?
Mm-hmm.
You're literally throwing you're going all in, and you got you don't even got a pair.
Right.
So it's like, it's not ideal, but we'll see what they do. Obviously, this is all going to be updating in real time as the market progresses. We're going to see how the reset. This is a great reset, by the way. A lot of people discredit the yield curve. They're a bunch of clowns. Don't listen to this nonsense. The yield curve has literally predicted every recession. You can go back and you can look at different yield spreads, but the yield curve is inverted, literally inverted. So
it's like as
something's
inverted
coming.
as it's been ever.
Yeah, something's coming, but the key is not the inversion, it's the reversion. When the yield curve reverts, that's when the bond market really thinks the Fed's going to actually have to pivot. So this bullshit that you're seeing right now about, the rate cuts, and that's nonsense. In reality, I would have more faith in the idea that Fed's going to pivot if the 2s and 10s were at zero, or at least well off their lows. We're barely off the lows. What's going? Like, think about it. The yield curve is telling you there's no recession coming, at least not yet. So why would the Fed pivot? Remember, the Fed's only going to pivot for a recession. I think that's where we'll wrap it up.